Tim Ord, how are you?
Good, good. Thanks for having me on again.
Great pleasure.
Go ahead.
So, yes, please. So, Tim Ord is the Ord Oracle. He is the Oracle, of course. He's been speaking to us about gold and silver for quite some time. He's been a bull. Tim, could you just tell us how to reach you and then go right ahead and tell us what you're looking at?
All right. You can catch me at www.ord-oracle.com. My email address is tim@ord-oracle.com. So that's how you can get a hold of me. So I'm also on Twitter. You can, I think, you can look me on Twitter, oracle.com, I think, or at oracle.com gets me on Twitter. So let's look at the market. The first chart here is the SPX. Give me something to draw with here. This is the daily SPX tilt ratio, and you can see what's going on here. You know, usually
just one second, Tim. There we are. Okay, we've got the charts. I just didn't want you to be talking, and we didn't have. Now we've got the charts. SPX/TLT. That's the S&P, and the TLT is the conglomerate that Tim puts together. Tim, go ahead, please.
Yeah. One's the SPX is the equity market. The TLT is basically the bond market. So I do a ratio with that, and basically this ratio should lead the S&Ps. For instance, right here we got on the top window is the SPX tilt ratio, which is making higher highs. The S&Ps is making higher highs. Everything's good. Should go out. You have a minor pullback for it looks like about 3 days, and the market rallied up, and you notice here, now we're making lower highs as the S&Ps is making higher highs, and that's the divergence. And if you notice over the last week, this ratio went right down. I mean, just really went down, and more or less, the SPS you can see over here on the window. This is a ratio, then it goes straight down. And where the S&Ps are still pretty much holding at its highs or recent highs, it really hasn't backed away much. That's a huge divergence. Now, this ratio can lead the market, by a week or so. So it just gives you a warning that a possible high may be forming. So that's one thing I'm looking at. And here's the other thing I'm kind of looking at. I also look at, panic and the ticks and trend. And actually, the trend's kind of high right now, which says the market may hold up. But the top window, this is on a weekly time frame. It's more of a divergence there. You can see, this is basically mid-August to the current time frame. You got a big divergence going on. So I'm thinking this S&P pattern that's forming here is a rising wedge, and we haven't really turned down yet, at least not yet. If you notice last Friday, this is last Friday's volume, and high volume highs are usually tested, and I think this high right there could be touched before we actually turn down. But you got a huge divergence going on that's been going on since 2 weeks, 2.5 weeks, thereabouts. So you got thinking, and also, this is kind of another indicator I use. This is the SPY VIX ratio.
Tim, can I just interrupt for a second? The one at the top is a closing price indicator, right?
Right, it's a closing.
Yes, okay.
These are both right. We're talking about the SPY tilt ratio?
Yes. No,
right,
the one before you, the top one had a single line. I just wanted to point that out because sometimes what happens with a single line, in between you can have a huge movement, but it's the closing price that really counts. I just wanted to point that out because that makes it even more pertinent.
Yeah, it's a closing price on the top line. That's right. And you had a big decline here. So anyhow, that's the divergence. Another indicator that I use, I like to at least have two of them. Here I'm just pointing out this is the SPY VIX ratio, and bottom window is the SPY. If both those indicators are going higher, normally the pullbacks are fairly mild. Then when you back here, basically in mid-August, everything looked fine, making higher highs, minor pullbacks, and now you're making higher highs. You can see it better over here on this bigger window
With
to
the
the
pink.
far right.
Yeah.
Yeah, see, here you're making higher highs on the SPY, and the VIX ratio is making lower highs. What that says is basically the VIX is starting to go up. And when the VIX starts to go up, even though the S&Ps are making higher highs, it's usually a warning sign. Again, this is kind of a leading indicator type things. It doesn't mean tomorrow is going to be a down day. Actually, I still think we'll go back up and test last Friday's high, which is basically this high right here, which is up around on the SPY is 65 and change, 652 area. We're probably going to make an attempt to test that. And so that's kind of a critical area to watch. If we test that on lighter volume, that would add bearish scenario to it. I put it that way. So anyhow, some things I'm watching. I'm out of the market. I'm not long. I'm not short. I think it's a little bit too soon to go short. If you are long, I think last Friday's high could be a target. It depends how that's tested. So we'll see how that turns out. But it's kind of a choppy market. I kind of stayed out of the market here. I made trade a couple of weeks ago. Made a small profit, but this range is getting super tight. And so it usually gets quiet at the tops. The market's kind of rolling over here, so I'm thinking we're going to pull back down around 6,200, basically, which is this low right here. So that's kind of where we're going. So nothing real significant to the downsides, but it's going to be a slap in the face. And that's probably a good 5% or better to the downside. So it's worth the trade. So nothing significant. Upside's about done. Downside hasn't started yet, so we're kind of in between a trade right now. So, the break's about ready to happen. We'll cover gold, which I got a lot to say about.
Good. So we've got a break coming up, Tim. You've got you've got your timing down as always. We'll be right back with Tim Ward. The Dow right now is up 179. The S&P is up 14. And we're all waiting to hear what you got to say about gold. We'll be right back with Tim Ward, Basil Chapman sitting in for Tommy O'Brien. Hi, folks. Basil Chapman sitting in for Tommy O'Brien. And we, of course, have on Tuesdays and Thursdays, we have Tim Ward. Tim, you would like to discuss the gold market. Let's go.
All right. We talked about this before on Tuesday. I just want to point out again, it's a little bit of a review, but I marked all the times where the XAU monthly ratio, so that's the gold stocks compared to the gold, and when this ratio is really high, gold stocks are expensive compared to gold. When it's really low, gold stocks are cheap compared to the price of gold. So it kind of measured the value of gold stocks against gold, and we've been basically setting at going nowhere since 2014. It's bounced around. It looks like about 0.05 to 0.08. We're in that vicinity right now, and the point I'm trying to make is, this ratio has gone sideways 2 years there, 4 years there, 6 years there. Actually went sideways for a long time from basically 84 to 2008. So what's that, about 25 years or something? Then finally broke out of that trading range to the downside. Now we've gone sideways in a real narrow range. This is a wide range here. This is a real narrow range, like 0.05 to 0.08, and we really haven't gone anywhere, even though gold's gone straight up. Gold stocks have gone up, but not any close to what gold has done. So I'm thinking we're going to break out of this 10-year trading range or 11-year trading range, and most likely we're going to probably break out. In my opinion, we're going to go back up to this 0.108. There's quite a bit of resistance there, which is basically the previous lows of 2000 or 1984 to 2008. And so there's quite a bit of resistance there, but I think we're going to go up there. Have we started that breakout yet? I don't know. I mean, gold stocks are just going kind of a gangbusters here.
Right.
And for this thing to break out, gold stocks will have to continue going gangbusters. So I'm thinking we're in the time frame that's similar to 2011, where the market went up for a number of years. And I think
Yes.
we're going to break out of this trading range. There's going to be we'll have consolidations along the way, but nothing like we've had over the last 12 years. Now, so how do I come up to that conclusion? Here's one indicator. This indicator goes back to 1982, and this is the silver gold ratio on a weekly time frame. So silver kind of identifies, well, it seems like when silver is high compared to gold, you're at a top in the equity market. And on the top window here is the GDX going back to 1984. So it's had its bull markets, bear markets. We're back in a bull market right now. But when this ratio gets above 0.02, seems to be the magic number. Now mark those areas in blue going past. And the buy area is anything below 0.12. 0.012, and we're still in that zone right now. I marked the times in pink are the times when that ratio's got to below 0.012, and we're coming in right now at 0.011, and so the silver gold ratio suggests equities are still cheap, I guess is what this implies. Anything above 0.02, you're getting expensive and you're probably going into a top. So this ratio really hasn't broke out yet. It's still, pretty much going sideways since 2022. And it's, to get to 0.012, 0.02 rather, gold, I don't know. I don't know how far that would have to go, but it's a long ways up from here. And there's another thing so the silver gold ratio on a weekly time frame suggests that gold stocks and actually silver stocks are still in a buy signal because silver has not outperformed gold that much to create a sell signal. When silver way outperforms gold, it's the time to sell, and that hasn't happened yet. Another ratio that I pay attention to is this is the HUY to NDX, which is basically gold stocks compared to the NASDAQ stocks. And this ratio goes back to 1992. And, I gave a buy pretty much in 2000, gave a sell in 2012. It's been in a downtrend since then. I actually talked about this with Tom Sr. back in 2023.
I remember, yes.
Yeah, it was a wedge pattern forming, and I was looking for a breakout in late 2023 to 2024, and lo and behold, we got it. And how long that's going to last? Well, it's going to last as long because I got an RSI to this ratio, which is the top window here. This is the RSI for the HUI index ratio, and so it got above 50 back in early probably 2001 and stayed above 50 for a good 10, 12 years.
I just want to point out for people watching, so this is the second panel from the top. It's with that rectangle with the blue, then the pink with the line underneath the pink, and then the line as it is right now turning blue.
Right. So, so this measures, the RSI measures this is a monthly ratio. So as long as this ratio is an uptrend, normally that's when this ratio stays above 50. When it's in a downtrend, this ratio stays below 50. So what that says, when the ratio is going up, HUI, the gold stocks, is outperforming the NASDAQ stocks. When the ratio is going down, the NASDAQ stocks are outperforming the gold stocks. And that's been going on since 2012. That's the reason why the RSI pretty much stayed below 50, because this ratio is down. Now we turned up, and notice the ratio, we're up around 65 or 65.42 be exact now. And so as long as this ratio stays above 50, which I think it could for the next 12 years, gold stocks will outperform the NASDAQ stocks. Will that be true? I don't know. This ratio, this downsloping wedge pattern has an upside target to where the pattern began, and that's around 0.05.
It's still a way up, way above.
It's a ways to go up. Will it get there? We'll have to wait and see. But right now, gold stocks are outperforming the NASDAQ stocks, and I think that's probably going to continue for that. I don't think there's going to be a slot market because this is an impulse wave. This is XAU, or no, this is HUI. This is an impulse wave going up. We'll have a consolidation at some point, which will probably be a sideways move that may last several months or maybe even 6 months. Then we should see another impulse wave to the upside.
Just to recap, so an impulse wave, in Elliott wave, an impulse is really a major trend.
Right. Actually, you can see it real good here. Here's an impulse wave. There's a corrective wave. Here's another corrective wave. Here's another corrective wave. But in between those are impulse waves. So here's an impulse wave, and here's a long corrective wave. And here's another impulse wave and a long corrective wave. I think the character of the market's now changing, where the sideways market, well, I hear the news.
Yes.
So, but I think that there's a big gold rally coming, and we're still in the early stages. I'll put it that way.
From your lips, Tim. You've been great so far. Thank you so much, folks. Check out Tim Ord, Ord Oracle. You can check it out. Always here Tuesdays and Thursdays. He'll be back Thursday. Thank you very much for being here. Have a great few days.
All right. Thank you.
Thank you.
Bye.